Hi, I'm Rubin, your retirement plan advisor, and today I want to talk to you about what happened in the second quarter of 2013. It was a pretty weird quarter. It started off really strong, but then at the end, kind of fizzled. The other thing I want to talk to you about today is a study that came out by the Society of Actuaries back in January. I think you'll find it pretty interesting, so let's go ahead and get started. This last quarter for the U.S. stock market was good, not great. A little mixed. You can tell that the REITs were down by about a little over 1%, but overall, the stock market up about 3% between large and small in value. That being said, the international stocks were hit a little bit harder this quarter. You see emerging markets down a little over 8%. Now, that's to be expected. Emerging markets is one of the more volatile asset classes that we have in our portfolios. Now, that being said, you can tell that if you look below that negative 8.1%, over 10 years, emerging markets have performed better than any other asset class. So I think there's still a lot of value to be had with our portfolio containing some emerging markets. Now, whether or not internationals continue to underperform the U.S., nobody really knows at this point. Certainly the dollar appears to be getting stronger, which is good for the U.S., not so good for international investments. But again, everything is pretty cyclical, so you never know who's going to be on top the next year. So it's important to be diversified across all asset classes, both domestically and internationally. The bigger surprise for a lot of investors was the bonds. Bonds were actually down for the first time in a long time. Now, these bonds are short-term, high-quality bonds. So in the global, between 1 and 5 years, and the government, U.S. government in particular, between 1 and 3. Bonds with longer duration were definitely impacted more. Now, even though they were down this quarter, overall for the 1 year, up ever so slightly. So again, no reason to go crazy, but it is important to know that the reason why the bonds have decreased in value is because of some statements made by Ben Bernanke and his belief that in the upcoming year, the Fed, which has been using various monetary powers to impact the market a little bit, is going to be paring back some of those. So there's an expectation that QE3, which is quantitative easing, which the government's purchasing any number of billions of dollars of bonds a day, is going to be ending sometime, perhaps in the near future. Interest rates also may rise in the near future as well. Given those things, it is important to note that investors generally try to stay a little bit ahead of the curve. So when Ben Bernanke said that he was going to stop maybe some of those programs, people started to sell and the bonds went down. Taking a look at the portfolios, you can tell that those who had portfolios that were more risky did a little bit better last quarter. Not by a whole lot. Those in 100% stock portfolios returned about 0.6%, and those in 100% bonds with no stock returned negative 0.2%. Now, over 1 year, that difference becomes much more drastic. And over 5 years, you can tell that those who were really aggressive weren't necessarily the best rewarded. Those that had the better stock to bond mix had better returns. Of course, that has the period of 2008 with that great crash in it. Now, over 10-year periods of time, those that are more risk-loving have better returns. Now, the important thing is that you are in the correct portfolio for what you want. Again, if you're not able to weather out those big storms, those numbers look very different if you try timing the market. So again, the important thing, be in the right portfolio for you. Back in January 2013, the Society of Actuaries put together a study, and they found that the median household income in the U.S. was $60,000. Those families were able to save $100,000 by the time they retired. The Society of Actuaries figured out that with $100,000, that $60,000 median household income family would have about a 29% chance of having positive net worth when retired, meaning that 71% would have negative net worth or no net worth at all. So how much would that median household need to save to have at least a chance at having a positive net worth? Well, to have a 50-50 chance, that $60,000 median income family would need to have $170,000 at retirement. To have a 95% chance of success, that family would have to have nearly $700,000. Needless to say, the median family is a long way off. Believe it or not, I actually find the Society of Actuaries findings to be very encouraging. If we start really young saving, we'll have a much easier time retiring. Now, as for the market, well, it's always going to be the market, and there's always going to be volatility. But as long as we have the correct stock to bond mix for our personal risk tolerance, in the end, we'll be okay as long as we can ride out those storms. Best of success in this third quarter of 2013.